If you have more than $25,000 sitting in any single checking or savings account in 2026, you are losing money in 3 different ways at the exact same time. And the most dangerous one is the one the bank will never warn you about. The other 2 are bad. They are quietly eating your savings every single month. But the third one is what gets retirees flagged, frozen, reported to a federal database, and in the worst cases, has their own money seized. In the next 18 minutes, I'm going to show you the exact dollar amount the Internal Revenue Service watches for. The second number that has no limit at all, and almost nobody knows about the 7 specific behaviors that automatically flag your account. Why keeping cash in a normal bank account is now mathematically the worst place you can put it, and the 5 accounts that financial planners actually use to protect their own savings. If you keep your money in a bank, watch this video all the way through. The number I'm about to give you is not the number the Internal Revenue Service tells you to watch. It is the number the Internal Revenue Service uses to watch you. My name is Ricky. I am an enrolled agent licensed to represent taxpayers directly in front of the Internal Revenue Service. And what you are about to learn is the same information I walk my own clients through before they retire. There is no version of this conversation your bank will ever start with you. Your bank profits when your money sits idle. The longer it sits, the more they make. So, they have zero incentive to tell you any of what comes next. Before I get into the numbers, I want to tell you about a client of mine. I am going to change his name. I will call him Robert. Robert is 68 years old. He is a retired union electrician from outside of Columbus, Ohio. He worked for the same company for 34 years. He had a pension. He had a paid-off house. He had a savings account at the same bank he had used since he was 19 years old with a balance of roughly $140,000. Robert was not wealthy. Robert was careful. Last winter, Robert decided he was going to help his daughter buy her first house. She lived in Florida. The down payment was $22,000. Robert had the money sitting in his savings account. He had been saving for exactly this moment his whole life. So, Robert walked into his bank on a Tuesday morning and asked for a cashier's check made out to the title company in Tampa. The teller took his withdrawal slip. The teller looked at the screen. The teller asked Robert to please have a seat. Then, a branch manager came out, asked Robert into a private office, and asked him a series of questions. Why did he need the money? Who was it going to? Had anyone instructed him to make the withdrawal? Had he received any phone calls, emails, or text messages asking him to transfer money? Had he met anyone new on the internet in the last 6 months? Robert, a perfectly competent 68-year-old man, was being interrogated by his own bank about helping his own daughter buy a house with his own money. The branch manager told Robert the withdrawal would be subject to a 48-hour compliance review. Robert had to drive to a payphone in a gas station to call his daughter and tell her the closing would have to be delayed. When the cashier's check finally cleared 2 days later, Robert thought that was the end of it. It was not. 3 weeks later, Robert received a letter from the bank telling him a suspicious activity report had been filed on his withdrawal with the Financial Crimes Enforcement Network. That report now sits in a federal database that will be cross-referenced against every future transaction Robert ever makes for the next 5 years. Robert did nothing wrong. Robert is a retired electrician who wanted to help his daughter. That is exactly what the new system is doing to ordinary American retirees every single day. And every single one of these flags, freezes, and reports starts with one simple fact. Robert kept too much money in one bank account. That is the only thing he did. And that one thing is what I am going to teach you to undo today. Let us start with the rule that everybody has heard about and almost nobody actually understands. The $10,000 reporting rule. Under the Bank Secrecy Act, anytime you deposit, withdraw, or transfer more than $10,000 in cash from a financial institution in a single business day, the bank is required to file a currency transaction report directly with the Financial Crimes Enforcement Network. That report includes your full legal name, your social security number, your date of birth, your home address, the amount of the transaction, the type of transaction, and the time it occurred down to the minute. The report is filed within 15 days. You will never see a copy. The bank is legally prohibited from telling you they filed it. The currency transaction report sits in a federal database called the Bank Secrecy Act database. That database is shared between the Financial Crimes Enforcement Network, the Internal Revenue Service Criminal Investigation Division, the Drug Enforcement Administration, the Department of Homeland Security, and roughly 400 other federal, state, and local agencies. Once your name is in the database, it stays there for 5 years. Every future financial transaction you make is automatically cross-referenced against your history. Patterns that look unusual get scored. Scores above a certain threshold get flagged. Flagged accounts get reviewed by a human compliance officer. That is the system. Now here is the part most people get wrong. They think if they stay under $10,000, they are safe. They are not, because the $10,000 rule is not the rule you actually need to worry about. The rule you need to worry about is a second rule called the Suspicious Activity Report, and it has no dollar threshold at all. A suspicious activity report can be filed on a transaction of any size, $100, $500, $2,000. There is no floor. The decision to file is made entirely by your bank's internal compliance team based on whether your transaction fits a pattern. Their software flags as unusual. The bank is required to make that decision within 30 days of the activity. The report goes into the exact same federal database as the currency transaction report. You will never be told it was filed. You have no legal right to know. And if a bank employee tips you off that a report was filed on your account, that employee has committed a federal crime called tipping off, which carries up to 5 years in prison. That is why your bank cannot tell you when a suspicious activity report is filed. It is also why your bank has every incentive to file one whenever there is any doubt. A bank that files a report incorrectly faces zero penalty. A bank that fails to file a report when it should have can be fined millions of dollars by federal regulators, and the compliance officers who missed it can lose their licenses. Freeze first, report first, apologize later, if at all. That is the entire incentive structure. So what triggers a suspicious activity report? I am going to give you 7 specific behaviors that bank compliance software is looking for right now. And I want you to listen carefully because most retirees have done at least 3 of them in the last 12 months without realizing behavior number 1. A deposit or withdrawal that breaks your historical pattern. If you have averaged $500 a week for the last decade and you suddenly walk in and ask for $8,000, that is a pattern break. The software flags it. The reason it is so effective is that it does not require you to do anything illegal. It just requires you to do something different. A grandmother who never withdrew more than $300 in 15 years, withdrawing $2,000 to buy plane tickets for a family reunion, will get flagged. The system does not know why. It does not care why. It flags the deviation. Behavior number 2, multiple deposits that when added together would have crossed the $10,000 threshold. 2 $5,000 deposits on consecutive days. 3 $4,000 deposits over a week. 4 $3,000 deposits over a month. The software is now sophisticated enough to detect these patterns over rolling windows of up to 90 days. This behavior is what federal law calls structuring. And under Title 31, United States Code Section 5324, it is a federal felony carrying up to 5 years in prison and forfeit of the entire amount, even if the underlying money is 100% legal. I want to pause here because the structuring law has destroyed the lives of hundreds of innocent Americans, and the cases are public record. A woman named Carol Hinders ran a Mexican restaurant in Iowa for 38 years. She made deposits below $10,000 because her insurance policy capped on-premises cash. The Internal Revenue Service seized her entire account, $33,000 in operating capital, with no criminal charges filed. It took 2 years of litigation and a public interest law firm working pro bono to get the money back. Lyndon Milelan, a convenience store operator in North Carolina, lost $17,000 to a structuring seizure. He was never charged with a crime. The Institute for Justice represented him for free and eventually recovered the money. Andrew Clyde, a firearms store owner in Georgia, had $940,000 seized. He spent years in federal court before getting it back. None of these people were criminals. They were business owners who happened to deposit cash in amounts under $10,000 for legitimate reasons, and the pattern recognition software flagged them. The money was seized through civil asset forfeit, which does not require a criminal conviction. The government does not have to prove you did anything wrong. You have to prove you did not. And while you are proving it, your money is gone. Behavior number 3, wire transfers in or out of an account that did not previously send or receive wires. The first wire is what gets flagged the hardest, even if the amount is small. Software treats the first wire as a high-risk event because it is the most common method criminals use to move money out of an account they are exploiting. Your bank's algorithm cannot distinguish between you wiring $3,000 to a contractor for a kitchen renovation and a scammer wiring $3,000 out of your elderly mother's account. So, it flags both. Behavior number 4, round number transactions in unusual amounts, a deposit of exactly $9,000, a withdrawal of exactly $7,500. The software is specifically trained to look for round numbers just under the $10,000 threshold, because that is the signature pattern of someone trying to evade reporting. The irony is that the very act of trying to be careful is what flags you. The compliance officer at your bank does not need to think you did anything wrong. The algorithm just needs to think the pattern looks suspicious. Behavior number 5, account activity that does not match what the bank knows about your job, your income, or your typical monthly pattern. A retiree on Social Security depositing $12,000 from an unknown source will get a flag, even if that $12,000 came from selling an old car or cashing in an insurance policy. This is why you should never deposit unexpected large amounts of cash into your primary bank account without preparing a paper trail in advance. If you cashed out a life insurance policy, keep the policy documents and the carrier statement. If you sold a vehicle, keep the bill of sale and the title transfer. If you received an inheritance, keep the executive's letter and the probate documents. When the compliance officer reviews the flag, those documents are what stop the suspicious activity report from being filed. Behavior number 6, cash deposits from a third party. If your son or daughter walks into your branch and deposits cash into your account on your behalf, the bank logs it as a third-party deposit. Third-party deposits over a few thousand are reviewed almost every time. The same is true of cash deposits at branches other than your home branch. Deposits made through the night drop box and deposits made just before or just after the bank's closing time. Anything that deviates from the normal way you deposit money is now scored. Behavior number 7, activity in or out of accounts linked to certain geographic regions, certain industries, or certain types of businesses. The software maintains a list of countries, area codes, and merchant categories that automatically get extra scrutiny. You do not need to be doing anything wrong. The flag is based on association, not intent. A retiree who wires money to a contractor in a state on the high risk list, even for a perfectly legal landscaping job, can trigger a review. So can a deposit from a relative who lives in a different country. So can a payment from a buyer who happens to have an address on the wrong block of the wrong zip code. Now, stack all 7 of those triggers on top of the $10,000 rule. And you can see why the answer for any retiree is not to learn how to avoid the line. The answer is to stop keeping that much money in a place that is being watched at all. Which brings me to the second danger sitting on top of your bank balance right now. And this one has nothing to do with the federal government. This one is just math. In 2026, the average national interest rate on a regular checking account is roughly 0.06%. On a regular savings account, it is roughly 0.40%. Both of those numbers are less than the official inflation rate, which is currently running at roughly 3%, which means every single month that you leave money in a normal bank account, the buying power of that money goes down. If you have $50,000 in a checking account, earning effectively 0 and inflation runs at 3%, you have lost $1,500 of purchasing power in a single year. The dollars are still there. The dollars buy less. You did nothing. You lost anyway. Meanwhile, that same bank is lending the money you deposited at rates between 7 and 12%. A bank with $100 million in retiree deposits earning 0.40% lending the same money out at 7% is making roughly $6.6 million a year on money that does not belong to them. That is the business model. Your money sits, they lend it, they keep the spread, you keep the inflation loss. The reason your bank treats you like a number, the reason your bank cannot answer simple questions, the reason your bank takes a week to release a wire transfer is that you are not the customer. You are the supplier. The customer is the borrower on the other side of the loan. The supplier is treated accordingly. The third danger most people are not even aware of is the Federal Deposit Insurance Corporation limit. Every account at every bank is insured by the Federal Deposit Insurance Corporation, up to $250,000 per depositor, per insured bank, per ownership category. If you have $300,000 in a single bank account and that bank fails, $50,000 of your money is not insured. You can lose it. You will not get it back. In 2023, the 3 largest bank failures in American history happened in a span of about 10 weeks. Silicon Valley Bank, First Republic, Signature, the Federal Deposit Insurance Corporation, covered insured deposits. Anything above the limit was at risk. Many depositors got bailed out as a political decision, but there is no law guaranteeing that will happen the next time. The next failure could be your bank. The next failure could happen on a Friday afternoon with the doors locked Monday morning. You will not get a warning. So the question is, what is the right amount of money to actually keep in a normal bank account? And the answer that financial planners give to their own clients is this. Keep 3 to 6 months of your essential monthly expenses in a checking or high-yield savings account and not $1 more. For the median American retiree, that is somewhere between $15,000 and $25,000. Anything above that number belongs somewhere else. Not because you cannot afford to leave it there, because every dollar you leave there is being watched, eroded, and used by someone else to make money you will never see. Now, here are the 5 places financial planners actually move the rest of the money. Pay attention because this is the value part of the video, and it is the part nobody explains for free. The first place is a high-yield savings account at an online bank. Companies like Ally, Marcus by Goldman Sachs, Discover, Capital One 360, and Wealthfront currently offer interest rates between 3.5% and 4.5% on savings accounts that are fully insured by the Federal Deposit Insurance Corporation up to $250,000. The money is liquid. You can transfer it back to your checking account in 1 to 3 business days. There are no monthly fees. There are no minimum balance requirements. Opening an account takes about 10 minutes from your couch. You will need your social security number, your driver's license, and your local bank's routing and account numbers to link the two accounts together. Once linked, the transfers between them happen automatically. That is roughly 10 times what your local bank pays you on the exact same deposit with the exact same protection. The second place is a Treasury bill. Treasury bills are short-term loans you make directly to the United States government. You can buy them in increments as small as $100 directly from a website called Treasury Direct, which is run by the United States Department of the Treasury. 4-week, 8-week, 13-week, and 26-week bills are currently paying between 4 and 4.5% fully backed by the United States Treasury with zero state income tax owed on the interest. If you live in a state with high income taxes like California, New York, Oregon, or Hawaii, that state tax exemption alone makes Treasury bills better than a high-yield savings account on an after-tax basis. The way to use Treasury bills as a retiree is to build a ladder, which means staggering your purchases so that something is maturing every few weeks. A simple ladder might be $10,000 in 4-week bills, $10,000 in 8-week bills, $10,000 in 13-week bills, and $10,000 in 26-week bills. Every few weeks, money matures and rolls into a new bill while always keeping a near-term option for cash access. The third place is a Series I savings bond. I bonds are inflation protected. The interest rate adjusts every 6 months based on the official inflation rate. So, by definition, the money does not lose purchasing power. You can buy up to $10,000 per social security number per year directly from Treasury Direct. A married couple filing jointly can buy $20,000 per year combined. You have to hold them for at least 12 months. If you redeem within 5 years, you lose the last 3 months of interest. After 5 years, there is no penalty for redemption. For inflation protection on money you do not need for at least a year, I-bonds are the cleanest tool available to a retiree, and they are the only investment in the United States that is guaranteed by federal law to keep pace with inflation, regardless of what the broader economy does. The fourth place is a brokered certificate of deposit. A regular certificate of deposit at your local bank locks your money up at a fixed rate. A brokered certificate of deposit is purchased through a brokerage account like Fidelity, Schwab, or Vanguard, and it gives you access to certificate of deposit rates from hundreds of banks across the country all at once. The current rates on brokerage certificates of deposit range from 4.5% to 5% fully insured by the Federal Deposit Insurance Corporation, with the ability to spread your money across multiple banks to stay under the insurance limit at each one. If you have $1 million to protect, you can spread it across 4 banks at $250,000 each in a single brokerage account in roughly 15 minutes. You can also build a ladder of brokered certificates of deposit at 3-month, 6-month, 1-year, 2-year, and 5-year maturities so that something is always coming due. The longer maturity rungs lock in the current high rates in case rates fall, while the shorter rungs keep you liquid. The fifth place is a money market mutual fund inside a regular brokerage account. Funds like the Vanguard Federal Money Market Fund, the Fidelity Government Money Market Fund, and the Schwab Value Advantage Money Fund hold short-term Treasury obligations and currently pay between 4 and 5%. They are not insured by the Federal Deposit Insurance Corporation, but they are backed by United States government debt, which is generally considered the safest asset in the world. Money market funds are completely liquid. You can move the money back to your checking account in 1 business day. There are no minimum holding periods, no penalties for withdrawal, and no caps on contributions. If you are a retiree drawing Social Security, drawing a pension, or pulling required minimum distributions out of a retirement account, the smartest setup is to keep 1 to 2 months of expenses in your normal checking account, 3 to 4 months in a high-yield savings account at an online bank, 6 to 12 months in laddered Treasury bills, and the rest of your emergency fund in a brokered certificate of deposit ladder spread across multiple banks. That structure earns you somewhere between 3 and 5% on every dollar, keeps the entire balance fully insured or government-backed, removes you from the suspicious activity scoring algorithms at your local bank, and gives you full access to the money on a sliding scale from 1 day to 12 months. The single move I push my own clients to make in their first year of retirement is to open one online high-yield savings account, transfer everything above $30,000 out of their local bank, and start a Treasury bill ladder with the excess. That one move alone on a typical retiree balance of $150,000 generates between $4,000 and $6,000 per year of additional interest with zero additional risk, zero loss of liquidity, and zero exposure to the suspicious activity patterns at the local branch. Over a typical retirement of 25 years, that single move compounds into somewhere between $120,000 and $180,000 additional dollars of income simply from moving money you already have into accounts you did not know existed. There are 3 specific situations that hit retirees the hardest, and that I want you to know about before you make any of these moves. The first is the required minimum distribution. Starting at age 73, the Internal Revenue Service requires you to withdraw a minimum amount from every traditional individual retirement account and 401k account you own. Those withdrawals get reported on a Form 1099-R, and they hit your bank account as a large deposit, often in the range of $15,000 to $40,000 per year. That deposit by itself can trigger a suspicious activity report at your local bank if the bank does not already know to expect it. The fix is to either have the required minimum distribution deposited directly into a high-yield savings account rather than your primary checking, or to schedule a meeting with your branch in advance and have them note the expected deposit in your customer profile. The second situation is the pension lump sum. When you retire, you may have the option to take your pension as a single lump sum payment instead of monthly checks. Those lump sums can be $100,000, $200,000 or more, and they show up as a single wire transfer into your bank account. That wire is going to get flagged for review the day it lands, no matter how legitimate the source. The fix is to have the lump sum wired directly into a brokerage account, not a checking account. Brokerage accounts are designed to handle large transactions and do not run the same compliance algorithms that retail bank accounts do. The third situation is the survivor benefit deposit. By the time the next compliance review happens, the balance the bank is watching is small enough to be uninteresting. If you take one number away from this video, take this one: $25,000. That is the line above which keeping money in a normal bank account starts costing you more than it earns, drawing more attention than it should, and creating risks you do not need to carry. Anything above $25,000 should be moved this month into the kind of accounts I just described in your own name with your full control. The Internal Revenue Service is not going to call you and tell you any of this. Send this video to one person you love who is over 60 and still keeps most of their savings in a single checking account. That one share might save them $4,000 next year, and a suspicious activity report they will never even know is filed. That is what this channel is here to do. I will see you in the next.